And welcome. It's episode number 35 of The Rent Roll, your podcast on all things rental housing. I'm your host, Jay Parsons. Last week's episode was all about the apartment REITs. This week, we're going to be going all SFR and BTR, single-family rentals and build-to-rent. We'll review highlights from the two big SFR REITs and their earnings calls, Invitation Homes and American Homes for Rent. Lots of good color there, as always. And we're going to hear some themes that were pretty similar from the apartment REITs. Good start to the leasing season, no signs of a slowdown, low resident turnover, minimal impact from tariffs. And then we'll hear some things that are unique to SFR, including the continued years-long pivot away from buying individual homes off the MLS and putting heavy investments into new construction. Build-to-rent product, both scattered and in BTR communities, kind of that hybrid multifamily SFR product. And then I'm going to share with you today my absolute favorite quote of the quarter, courtesy of Invitation Homes CEO and past guest of the Rent Roll podcast, Dallas Tanner. He made an absolutely brilliant point about the homebuyer market that runs very counter to the mainstream narratives of today, but also rings true with a theme I've talked about a lot on this podcast and that I believe is backed by the data. So stay with us for that. It's going to be a good one. And then today's interview will be with Branden Lombardi, the president of BB Living. Some of you know BB Living was a very early player in the build-to-rent market and still a very active player today. We're going to talk to Branden about how BTR construction strategies are evolving in this high-rate flat rent market. Some cases, rents are falling for these new leases on build-to-rent product, and why BB Living is seeing opportunities for more infill suburban BTR development. That's something I've been asking BTR players about for years, and because so much of it's been concentrated exurban. And so I'm excited that BB is doing some of that. Traditionally, again, most BTR has been more exurban and suburban, concentrated in a lot of the same kind of high growth submarkets further out. And with those suburban infill lots are typically much more pricey, therefore requiring higher rents and or more density. But I've always thought, I think the demand for BTR product is not just exurban. And so surely there's got to be some infill opportunities as well. So we're going to talk to Branden about that, what he's seeing, and how you could potentially make that work. All right, before we dive in, I want to give big thanks to our sponsors. First and foremost, to JPI, leading apartment developer with a stated purpose to transform building, enhance communities, and improve lives. And also, thank you to Waymaker, multifamily investment group focused on attainable and Class A market rate apartments, partnering with best-in-class apartment builders across the Sun Belt. All right, as we always, we kick it off with here's a chart. And our charts this week are highlights, top 5 takeaways from the SFR REIT earnings calls, and some colorful charts to go with it. So first and foremost, number 1, strong start to the leasing season. Okay, so just like apartment REITs, the SFR REITs reported some improved momentum in Q1 and no signs of any real slowdown despite all the noise in the economy right now. Now, remember, some of you may remember that Q4 was actually a bit softer than a lot of people thought it would be. New lease rents went negative, even if just slightly, for the first time in, I think, about 10 years. And that's a point worth repeating, that slow home sales have not actually been a big boon to the SFR market, at least not in terms of SFR rent growth, even if it is a factor in low turnover. And so I'm going to get to Dallas Tanner's point on this in a moment, but let's talk about Q1 first. We did see a bit of improved momentum in new leases. We're back positive between the SFR REITs. We combined weighted average of them as calculated by our friends at John Burns Research and Consulting. That number is now 0.5%. Positive. And then renewal rent growth held pretty steady. They're just under 5%, actually 4.9% specifically. So blended rent growth ticked up to 3.6%. Same home occupancy rates also went up, hitting 97% for the combined REITs. And John Burns noted that was near or above pre-pandemic seasonal norms. So still a tight market. But that new lease pricing has been soft due to increased supply in a lot of markets, causing homes to sit on the market longer between leases. All right, a few highlights here. Charles Young from Invitation Homes, he said, thanks to the hard work of our associates, our peak leasing season kicks solidly into gear with new lease rate growth that's accelerated each month since December. In addition, bad debt has continued to improve, underscoring both the strength of our customer and the defensive nature of housing generally. Brian Smith from American Homes for Rent, he said, as expected, we have a strong start to 2025. Our top line metrics have sequentially accelerated each month since the start of the year. And he also said that leasing activity continued to strengthen into April, as Invitation Homes said as well. And I've got a chart here showing these rent growth trends, chart courtesy of John Burns. And again, you can see that a little bit of modest acceleration between Q4 and Q1. Obviously, a little bit of seasonality in there, but it is important to see that that shift upward and from negative rents and for new leases in Q4 now being positive in Q1. And at least based on the color that was shared in these calls, it appears that we should see those numbers stabilize. But again, rent growth, people need to remember this. Rent growth was higher when homes were selling like hotcakes. And today they're not selling and rent growth has compressed, especially for new leases. And honestly, even for renewals, still good renewal growth, but below what we saw in the hot period of 21 and 22 in the peak of inflation. All right. Takeaway number 2 from the SFR REIT earnings calls: building, as in construction, still tops buying. And the REITs are seeing more opportunities from home builders in terms of buying, but not off the MLS, but buying instead directly from home builders, new construction. The SFR REITs continue to be far more active builders than buyers when it comes to single-family homes. This has been a story for a number of years now. Despite all the scary headlines we read, most institutions, including the REITs, are just not buyers of many individual homes off the MLS these days. They're focused on BTR construction, as well as on buying portfolios of existing single-family homes from smaller operators. And remember, the vast majority of the market is comprised of small and mid-sized operators, not institutions and REITs. And so there remains substantial opportunity for roll-ups, particularly as there's more of a spotlight in the industry, higher cost, higher regulations. That really favors larger players with more scale. And I think we'll continue to see, some consolidation over time, even if the market remains deeply, deeply fragmented. So for the SFR REITs to be doing this, buying portfolios and building new construction, they're recycling capital by selling older houses. And Invitation Homes noted that the first-time home buyers are often the ones buying these homes from them as they recycle capital. So Dallas Tanner Invitation said, during the quarter, we acquired 577 wholly owned homes for approximately $194 million, nearly all of which were newly built, while strategically disposing of 454 homes, many to first-time homeowners. Additionally, we're helping our partners develop nearly 2,000 additional homes in many of our West Coast and Sunbelt markets. Dallas also hinted about potential portfolio acquisitions that could be announced later this year. So we'll see if that materializes. Over at AMH, Chris Lau said that AMH delivered a total of 545. I don't want to shortchange it by one there. 545 homes to our wholly owned and joint venture portfolios during the quarter. Specifically for our wholly owned portfolio, we delivered 424 homes for a total investment cost of approximately $173 million. Additionally, consistent with our plan, we continue to lean into our disposition program, selling 416 properties in the quarter, generating approximately $135 million of net proceeds at an average economic disposition yield in the 3% range. One interesting sub-theme here is that the SFR REITs are seeing more opportunities to buy from home builders, given the challenges that home builders are having with a more sluggish sales market due to today's high rates, high prices, broader consumer uncertainty, et cetera. So Dallas Tanner Invitation Homes said, we're getting to see more deal flow. There's no doubt about that compared to where we were maybe a year ago. I think development and development costs aren't necessarily coming in. So it's more about finding stuff where a seller or a partner is willing to build at a margin that's a bit more accretive than it was maybe a year or two before. And Chris Lau from AMH said, we have seen a pretty notable uptick in builder inventory opportunities. We screened plus or minus 25,000 newly constructed national builder properties, and which is pretty remarkable, which is a pretty considerable increase. Last quarter, I want to say we screened something like 15,000 opportunities, so a pretty big uptick for the quarter. Chris also noted, though, the vast majority of these either didn't fit AMH's buy box in terms of the location and property type, and that those that did fit the buy box often had yields in the 4s, which wasn't high enough for them. So for AMH, they said those types of yields make their own in-house development program more attractive. Chris said their in-house development projects deliver yields around 6% or higher. So that's a spread of 100 to 200 bips. Also wanted to share, I mentioned earlier, our friends at John Burns Research and Consulting, they have some great data here on build to rent starts. And so I want to tie that into this. And this will also lead into our conversation with Branden later today in today's podcast. When you look at build to rent starts across all BTR product types, we were down at least 60% year over year in 2024 compared to 2023. I believe it was fewer than 30,000 BTR starts nationally in 24, and that compares to close to 75,000 in 2023 and a little more than that, close to 80,000 in 2022. And so that's just like the apartment side, where we can see far more completions than starts, pointing to a lower supplied environment in the next couple of years. And then when you look at the delivery schedule, John Burns has a great chart that those of you watching on YouTube or the video can see this. It shows the estimated build to rent delivery schedule by month. And you can see we're very much past that peak. The peak was somewhere around the middle part of 2024. It's come down. And so BTR supply is actually decelerating probably a little faster than multifamily. And then what it's showing us is that, in fact, I'll just read a clip from it here. It says, John Burns says, run rate deliveries are currently at 5,000 units per month, down from 7,500 1 year ago. In 1Q of 2026, John Burns expects monthly deliveries to fall below 3,000 units per month. So with that backdrop, again, we'll talk more about BTR development opportunities in the interview portion of today's podcast with BB Living. So stay tuned for that. Next up, though, let's keep it going with highlights from the SFR REIT earnings calls. Next up, resident turnover remains very low and renters remain financially healthy. All right. So first of all, just like apartments, the SFR REITs are not seeing any signs of eroding financial health among SFR renters. At AMH, Lincoln Palmer said, we haven't seen any indications so far of a weakening in demand or in consumer behavior. As we go into April, we saw foot traffic increase in our homes from first quarter to April. We saw leasing improve year over year, and that's on top of the improved month over month rate growth and occupancy that we saw. So we have no concerns so far. And of course, turnover remains low in part because the lack of move-outs to home purchase and the discount to rent versus buy obviously remains substantial, around $1,000 or more per month in most markets. Dallas Tanner said, we've seen renewal rates as high as 80%. Or retention rates, I should say, about 80%, which we would not expect. Traditionally, pre-pandemic, we're sort of in the low to mid 70s in terms of how often we renew. And then through the pandemic, it sort of creeped up into the 70s and the high 70s. Our move out to homeownership buying is as low as it's ever been on our surveys. And that continues to lend itself to this thesis that the customer is going to stay longer and longer. But here's where I also want to bring up a really crucial comment that Dallas made, and I alluded to this earlier. I think one of the key quotes from the Q1 earnings calls, something I think is widely misunderstood, not only across media and policy circles, but even inside the industry, even a lot of industry events and in some fundraising, I think this is misstated, and that's the impact of a slow home buyer market. There's a very flawed perception that weak home sales equals a boom for the rental market. But there's just no historical evidence of that ever being true. And obviously, as we've gone through some of this data, it's really not the case. Again, I mentioned this earlier. Rent growth was better when homes were selling. So here's what Dallas said. Here's this great quote. He said, it's not anything that we would view as the ordinary course to be an 80% retention business. I think if homeownership picks up, it's hugely positive for a couple of reasons for our business. One, it's a healthier market overall. We prefer that candidly, where there's enough supply in the market and enough transaction volumes where you get a better sense of values. And two, if home appreciation starts to pick up, that is actually a proxy for where rents typically go. And so in our business, as the values of our assets increase, typically you'll see that the rents are increasing as well. And Dallas is right on there. Like I always say, everyone in the rental housing market should be cheering for a healthier for sale housing market. All right, let's jump to point number 4, the fourth takeaway from SFR REIT earnings call season. The REITs continue to emphasize strong performances in the Midwest. Invitation Homes also noted improved momentum in the West Coast as well. Both lower supplied markets, still supply driven softness in much of the Sun Belt, a lot of new BTR product, plus so-called accidental landlords adding supply to the SFR market. But both REITs noted some bright spots or encouraging signs of momentum in the Sun Belt as well. But let's talk about the Midwest for a moment. At AMH, Chris Lau said the Midwest continues to be a fantastic market for us. We saw that continue into April. New lease spreads there were almost 9% off of a 5.8% for the first quarter, and 9.8, so 9% for April. That's following 5.8% for the first quarter. And then he said that's great acceleration. And AMA said they're looking to expand in the Midwest. Brian Smith said we do have a land pipeline in the Columbus market. We're very excited about getting those lots repaired and developed and into the system. It's been a fantastic market for us, and we're looking forward to the results there. He also noted expansion in Indianapolis, and by the way, both Indy and Columbus are also, kind of big expansion markets in the apartment world as well. So that all aligns. And outside the Midwest, Brian said that AMH would like to see an acceleration of the portfolio footprint in the Carolinas. So that's Sunbelt, but obviously a hot growth market, of course. And then for Invitation Homes, similar themes, but also a call out to the West. Charles Young said, our Western U.S. markets are experiencing strong occupancy and robust renewals and new lease rate growth, with the exception of Phoenix, which we've previously called out, along with Texas and Florida, where we continue to see keep a close eye on some of the ongoing supply pressures. Nevertheless, we've seen some encouraging signs in these markets so far this year, with solid absorption and steady improvement, including a return last month to positive new lease rate growth. And I apologize, I keep tripping up over these quotes a little bit. I get so excited to read them to you. But hopefully we're tracking along. All right, so despite the current sluggishness in the Sun Belt, Invitation continues to be bullish about the long-term outlook there. It's committed to expansion there. I also mentioned AMH want to be expanding in the Carolinas. From Invitation Homes, Dallas Tanner said, I expect us to continually add markets over the coming years, but look for us to double down and double click on these Sunbelt and Southeast markets where we know that they're going to have a propensity for better growth for longer. All right. Takeaway number 5 from the SFR REIT earnings calls. Minimal impact from tariffs, but emphasizing the value of SFR in uncertain times. Okay. Again, similar theme from the apartment REIT calls. Brian Smith from AMH said there'd be no impact to current projects from tariffs. For future development, Brian estimated increased costs of 2 to 3%, which is in line with the apartment REITs and most private multifamily and BTR builders have said as well. Brian said that the impact from tariffs is, quote, small, and that's partly due to the fact that there's a lot of labor and there's a bunch of other components that come in, and the materials that are being subject to tariffs represent a small portion. The impact to ongoing operations is also likely to be pretty small. Invitation Homes' Charles Young said that we're monitoring the situation closely. It's too early to tell where it's going to flow through. Now, Charles did say one category they're watching is HVAC as well as appliances, but that it's, quote, a small part of our overall book. More broadly, both REITs also emphasize the resiliency of SFR in this uncertain economic environment. Obviously, uncertainty remains a theme across the industry at large and really, all investment categories at large. Dallas Tanner said, in general, in periods of economic uncertainty, SFR occupancy has tended to remain steady and rents have held flat or even increased slightly. And so really both REITs making the case for SFR and regardless of where the market conditions go. All right, there's your recap of SFR REIT earnings call seasons. I'm going to have a little more detail coming out in my newsletters. If you're not subscribed to that, you can find that at jparsons.com. All right, next up, rental housing trivia. All right, today's question is, large SFR owners with more than 1,000 homes in their total portfolio comprise just 0.01% of what major U.S. market, according to good folks at John Burns Research and Consulting? It'll be 5 choices at Boston, San Francisco, San Jose, Los Angeles, or New York. In one of those markets, large SFR owners represent just 0.01% of the market. So give that a guess, and we'll give you the answer here in a bit. But next up, in the news. All right, this is where we review headlines touching on rental housing themes. The first one comes courtesy of Bloomberg, and it says, U.S. housing starts increase on pickup and multifamily construction. Okay, so I'm sure a lot of eyes rolled when we see this one. And in fairness to Bloomberg, this was data from the census. They're just quoting what the official government source says here. The article says, U.S. housing starts increased in April as a pickup in multifamily home construction more than offset a decline in single-family dwellings caused by elevated inventory. New residential construction increased 1.6% to an annualized rate of 1.36 million homes, according to government data released Friday. The advance was driven by a 10.7% jump in construction of multifamily housing, such as apartment buildings. Okay, that's not happening. The census data has been wonky. I've talked about it before. It's based on a small sample of permit holders. It's not nearly as granular as what the leading private sector data providers collect. When you look at those better sources, we're not really seeing any material pickup in starts, nor is there anything in the macro environment quite yet that would suggest we would see a double-digit increase in starts. I do think we're probably leveling off, bottoming out after a long pullback, but I don't think we're jumping back up by double digits again. Not yet. At some point we will, but not yet. All right, next headline comes from the Wall Street Journal. It says, America's college towns go from boom to bust. Many state universities are losing more students every year, failing the local economies they once fostered. All right, I'm going to read a little bit from this article because it's quite interesting and aligns to some themes we've heard a lot about in the student housing industry of late. It says, for generations, colleges around the U.S. fueled local economies, creating jobs and bringing students into shop and spend. Growing student enrollment fattened school budgets and freed universities having to worry about inefficiencies or cutting costs. The student boom has since ended, and college towns are suffering. It also notes that the number of students graduating from American high schools is expected to start falling next spring after reaching a record high this year. But large flagship universities, blessed with strong academic reputations and high-profile sports programs, continue to boost local economies. In such cities as Ann Arbor, Michigan, the University of Michigan, Ann Arbor, the University of Wisconsin in Madison, Gainesville, Florida, or University of Florida, students are filling dorms, restaurants, and bars. A Wall Street Journal analysis of 748 public four-year colleges and universities in all 50 states shows that full and part-time enrollment at the most prominent state universities increased 9% in 2023 compared to 2015. At lesser-known regional state universities, enrollment fell 2%. The shift represents tens of thousands of students who have abandoned struggling college towns. Now, of course, as I alluded to, this aligns with the student housing investors and operators already knew. There's a flight to quality among colleges and college towns. That's true among students. They want to be in cool places to go to school, not just, the article made reference like they want to go where they could get a better job potentially on the road. Well, sure, that's part of it, but also they want to be in a cool place to go to school. And there's definitely a correlation there. And the Power 5 schools, elite private schools are generally doing fine and still generally in high demand. And others are not as attractive these days, both incoming students as well as the capital. Again, there's exceptions. These are broad brushes, but that's certainly a general trend that we're seeing. Next headline comes from MarketWatch. It says, these companies are replacing mom and dad as a guarantor for renters. It will soon be a $1 billion a year industry. There's a burgeoning business and companies that will pay your rent if you can't, but it can cost the equivalent of a month's rent or more. All right, so this isn't anything new for most of us in the industry, but it's interesting to see this get picked up in the media. It's an interesting business that essentially helps expand access for renters, which is an important issue, while mitigating risk for the property owner, which is also an important issue. So that's potentially a win-win if it's done right. All right, next headline comes from OpportunityZones.com and our friend Jimmy Atkinson, who runs that. Opportunity Zone legislation advances but misses the mark. So I've talked about this before. Opportunity zones have been incredibly impactful. They've led to the creation of 313,000 housing units at a low subsidy of 26,000 unit that makes OZs perhaps the most efficient, effective housing supply creation program in existence, according to some research by the Economic Innovation Group. But the program's expiring. And so the new tax bill, the one big beautiful bill, it's intended to replace and expand and extend the Opportunity Zone program, but there are a few issues with it. I'm not going to go through all of them in great detail, but I'm going to share a few things that Jimmy wrote, as well as what Branden Lombardi, an Opportunity Zone developer, who's also past guest of this program, has shared. Number one, it creates a dead period that could choke out projects. That's really the biggest problem. The House bill sunsets the current OZ map early. And what that really does is, while we're waiting on a new list of census tracts to be approved for opportunity zones, you have projects that are in advanced planning stages that are essentially jeopardized because you can't move forward on those if you don't know they're going to be grandfathered in. And then you can't go to the next project yet because you don't know where Opportunity Zone 2.0 maps are going to be. And that's probably going to be determined by the states if we repeat what happened with OZ 1.0. And so that creates this kind of dead period, this lull. Remember, it takes years to get sites secured, entitled, funded, built. And so, if we have a pause where the OZ 1.0 maps are expired and 2.0 are not yet released, then you're going to have a drop off in development. Number two, it reduces incentives for new projects. Jimmy wrote that a single 10% basis bump after 5 years may look fine on paper, yet it slices today's 15% maximum benefit by 1/3, eliminating the 7-year hold benefit. And then the third thing is pretty interesting that I want to share is that it sets an unrealistic cap to invest ordinary income. So this was an important change that had been really pushed forward to expand access to the program, is to allow investors to invest ordinary income into OZ projects instead of just capital gains. However, the House bill caps ordinary income investments at just $10,000, which, anybody who's raising capital knows that's just impractically low. So our friend Branden Lombardi said it well. He said a $10,000 annual cap means no one will use it. Most OZ funds have $50,000 to $250,000 minimums. No one's going to be setting up legal and tax infrastructure to save $300. And he's right. All right, and our last headline is going to take us back in the single-family world. This one comes from the Indianapolis Star, and it's an opinion piece from a writer at the Indianapolis Star, James Briggs. The title is "Fishers and Carmel," which are two suburbs, "don't think renters deserve single-family homes. Homeowners don't want to share neighborhoods with renters, so Fishers and Carmel are codifying their preference and justifying it by tapping into the moral panic over institutional property owners." And he writes here that Hamilton County cities are scapegoating Wall Street so they can award affluent buyers and existing homeowners with exclusive access to single-family houses and keep away unsavory renters. City officials in Fishers and Carmel argue it's necessary to ban renters from subdivisions where single-family homes hit 10% renter-occupied. So that's the rule here. So if you get 10% of the neighborhood that's renter-occupied, you can't add any more. So James continues, he says, of course, this isn't just about landlords or Wall Street. Homeowners don't want to share neighborhoods with renters, so Fishers and Carmel are codifying their preferences and justifying it by tapping into the moral panic over institutional property owners. This obsession is disingenuous. Based on Carmel's figures, only about 2% of the city's housing stock is owned by institutional investors. Investors are neither juicing nor destroying home values. They're 1 out of 100 factors influencing housing economics. Housing is unaffordable because we just don't have enough of it. It's that simple. And he's right. All right, let's return to our rental housing trivia question of the week. It was large SFR owners with more than 1,000 homes in their portfolio, national portfolio, comprised just 0.01% of what major U.S. market? Was it Boston, San Francisco, San Jose, L.A., or New York? And the answer is C, San Jose, California. Now, all of these have a tiny share of large institutional players, but San Jose was the lowest. And why? Well, very high home prices and low inventory makes it hard to achieve scale. And so mostly older homes require more CapEx, and very few of them hit the market. And it tends to be that markets are challenging for individual home buyers to access, also tend to be harder for even institutional capital to access. Okay, that's going to take us to today's interview, and I'm honored to welcome in Branden Lombardi, the president of BB Living. BB Living was a very early player in the build-to-rent market and still a very active player as well. We're going to talk to Branden. I mentioned this earlier. I'm excited to talk to Branden about how BTR construction strategies are evolving. Obviously, high rates, flat to falling rents, but also in particular, why he's seeing opportunities for more infill suburban BTR development. So that'll be a big topic of today's conversation. So let's welcome in Branden. And now we enter the interview portion of today's podcast, and I'm honored to welcome in my friend Branden Lombardi from BB Living. So Branden, thank you so much for being here today.
Thanks, Jay. Great to be here.
All right. So I wanted to start off, let's just kind of lay the groundwork a little bit. Tell us a little bit about BB Living, the background story, and also how you got into BTR.
Sure. So just a little bit about myself. I started in the real estate industry about 21 years ago, working for Land Advisors organization. I worked with Greg Vogel, the CEO there, for a number of years and really learned a ton about not only the land business, but the real estate market as a whole. And as I got into my career, I started right in 2004. It was a great time, especially in Phoenix, to be a land broker. Learned a ton working on some of the larger master plan and large residential subdivision deals that Land Advisors was working on around not only the Phoenix market, but across the country. I really learned as we got into the GFC and in the tougher times that being a broker wasn't for me. I didn't really like being the middleman and didn't really like not having a say in the ultimate outcome of what was going on. And so a few years later, I made it kind of all the way back as the market was starting to recover, decided that I would go do something else. I joined what was at the time the first public SFR REIT, the Beazer Pre-Owned Homes REIT, working on acquisitions there. And really that's where I got to kind of find my stride and my strong interest in rental housing. I had never dealt with anything kind of above the curb, as they say. And that was a really good time to be in the SFR space, working on thousands of homes at a time across the country and really starting to kind of see the opportunity unfold. And obviously at the time, nobody really knew what SFR would become, 10, 15 years later. But what was interesting is at that same time, my now partners at BB Living, the co-founders, Matt and Sam Blank and Daryl Berger, had all relocated here to Phoenix and were starting to play in the SFR space as well. And that's really where our paths intersected. I had left the Beazer Pre-Owned Homes REIT as it was getting rolled up into, what is now American Homes for Rent. And Matt, Sam, and Daryl had bought, 40 or 50 homes on a scattered basis. They were pitched on the idea of, hey, there's all these foreclosures out there. You can go buy them kind of on a per pound basis. Let the housing market recover. And in the interim, you're going to generate rental revenue. And when home price appreciation returns, you can sell off these homes. And that was really the thesis back in the day, right? So those guys started doing that about that same time. And then all that institutional money started pouring in, and overnight yields went down and the cost to acquire these homes went up. And Matt, Sam, and Daryl looked around and said, shoot, we don't want to be out of business, months into this. And after relocating families and everything to Phoenix, and to their immense credit, what they did see was there was demand for a differentiated rental housing product, right? 90 to 95% of all apartments are studios, ones and twos, very little 3-bedroom product. And even what it does exist isn't really geared towards families, but single family homes give that lifestyle and that experience that people have always wanted. And there just wasn't a kind of consistent supply of that from a rental perspective. So what the guys decided to do was, looking around, you could buy finished lots below replacement cost at the time. You could build a new home, lessen the cost of these existing homes. So they had the idea, let's build a neighborhood of homes instead of selling them off. Let's just own them and rent them out and operate it more like a multifamily community. So, BB Living started with one community here in the Phoenix area called Higley Park down in Gilbert, Arizona. It was 185 homes. Couldn't get a partner to invest, a bank to lend, couldn't even get a GC to build it. And so the guys really bootstrapped the whole thing. And even in the early days, you walked into the model home. If you wanted to lease, you went left. And if you wanted to buy, you went right. So they were trying to defray the risk because nobody really knew how much demand there was. But pretty early on, after about 35 sales or so in an equal number of rentals, the rental demand and the yields were so strong, the decision was made, let's just build the rest of this, start renting them out, and go from there. I joined just as that project was finishing up, and we started working on a number of other communities, kind of fell into our kind of very early investment thesis. By accident, we bought lots at Verado and Distancia here in the Phoenix market, two master plan communities. And that's when we started to see, hey, like we could be a great segment in these larger master plan communities. It gives somebody the alternative to, try before you buy when you live in these communities. But they had great schools, great amenities, great access, all the things that were really driving people to buy homes in these communities had a similar effect on people wanting to rent. So that's really where we started here in Phoenix. We built about 1,000 homes on our own between 2012 and 2018. And then we started looking to expand beyond the Phoenix market. There were others in the build-to-rent space that had started to expand across the country. And we formed a partnership with Toll Brothers in 2018, and then brought in our longtime now capital partner and really kind of accelerated that expansion going into COVID. So, today we have about 16 communities across the country that are open and leasing. It's about 3,000 homes. And we have another 10 to 12 communities coming behind that in the pipeline.
Yeah, that's great. I mean, you guys are definitely one of the early players. There'll be a lot happening in Phoenix those early days. Groups like yours and Next Metro, and obviously elsewhere. Redwood Communities up in the Midwest is an early player too. So it's come a long way since then.
Sure.
So Branden, talk a little about, you've alluded to this a little bit with the pre-existing pipeline. Just give us a little more detail on the current activity in terms of starts. Obviously, you mentioned some construction, but are you still able to get new starts going in this environment? Obviously, it's a tough environment for all types of housing starts right now, especially on the rental side.
Sure. Well, I think one of the things that happened was, obviously going back just a few years to COVID really kind of stretched out our starts and deliveries in our portfolio in Fund 1.
Sure.
And so I think from where we had projected to be to where we are is a little bit different. So this year we're going to do about 300 new starts, and then, it'll kind of start picking up a little bit more next year, and then, much more back to kind of 1,000 starts a year in 27.
Yeah, we're talking
just
about
a little bit of a
right?
Lull. Yes, 300 homes. Yes, correct.
They listening,
300 homes.
300 properties. No, yeah.
Yeah, no, sorry. But, we'll deliver 1,000 this year. That will tail off next year and then pick back up. And that's really kind of our goal, about 1,000 starts, 1,000 deliveries per year, which is a pretty good pace. And, we're not the volume player in the space. We're a little bit more focused on quality and location, and really those things being what drive our value and our returns.
So let's talk about the lease environment right now for BTR especially. And I've talked about this a lot in our podcast about apartments. And I think, BTR has some similar trends where we've seen good demand, but it's impacted the rents. It's a very competitive leasing environment, in part because we see a lot of the BTR product across the country. And I don't want to paint too broad of a brush, but generally speaking, we see a lot of submarkets where, again, the demand's there, but also a lot of BTR supply competing for the same renters, and it's impacting rent. So what are y'all seeing right now in the properties you have in the homes you have in lease up?
Yeah, I'd say in 2025, leasing started off really strong through the first quarter. I think better than anybody had expected. And as now we've gotten into the spring season, I think we've seen a little bit of a pullback from a demand activity perspective. I don't know if that's activity that's being, kind of sidelined by everything that's happening in the macro environment, or, truly just that continued supply impact that we're seeing. And I think that's one of the things, I'll be honest, I had a bit of a different perspective on this just a couple of years ago. I didn't really think, hey, all this multifamily supply, yes, there's a lot of BTR supply coming on, but in a lot of locations, it's really us and maybe one or two other BTR communities, but the vast majority of the supply is multifamily, conventional multifamily. I didn't really think that would have the same impact on our business as it ultimately has, right? Just renters still not having maybe the discernment of saying like, hey, I can rent a 3 or 4 bedroom home for this price, or a 3-bedroom apartment for this price. They're not necessarily making the decision to go to the BTR community each and every time. I think that's kind of one of the things that's impacting demand. But, leasing is good. It's just not, it's not on fire. And I think where we thought we were going to go from how the year started, it's slowed down just a little bit as we've gotten into the April and May part of the leasing season.
Yeah, so I want to dive into that more, but first, let me ask you a few follow-up questions. First, when you think about the current market, and obviously a lot of questions about what's going on, the economy, and you have supply competition, whether it's apartments or BTR, there's a lot of like just kind of short-term noise. How do you,
Yeah.
trying to figure out how to phrase this correctly, but how do you kind of separate that versus the longer term story for BTR? Meaning, like my perception, I'm sure you agree, is that we're still in the early innings of the BTR sector. So how do you kind of separate that short term noise versus a long term opportunity?
Yeah, I think it's a really good question. I think the short term part of it is everybody's got to get heads in beds, right? And so there really is that fight for the consumer. And I think that's one of the things that we're spending a lot of time focusing on is really getting that broader understanding of what we're offering, right? So getting out into the market. I think if you went to a barbecue on a Saturday afternoon and you were talking about the real estate market or what everybody does, and you started talking about build to rent, if they're not real estate people, they don't have any idea that build to rent exists. That the opportunity to go out there and rent a brand new home for much less than the cost of home ownership, like that is not on people's radars. And so I think we have to really do a much better job as a broader industry in selling what we're offering to people. And so I think that's where we take the long-term view of, yes, to your point, it's still the very early innings. And while we're very focused on, near-term occupancy, leasing goals, stabilization, all of those things, we really do need to take that long-term approach that, hey, we're still only hitting a very small part of our target audience. And there's a ton of opportunity and demand. And especially with affordability being what it is today, I think you're going to start seeing more of that conversation around, hey, should I rent a home or should I own a home? I mean, you were talking about it the other day, right? Warren Buffett talks about, the cost of home ownership versus renting and what you could do with that money that, you're saving for a down payment if you simply invested it in the S&P. And I think that will start to resonate with more people over time. But we're also not anti-home ownership. The vast majority of our move-outs are people that are going to own a home. And so we like to think of ourselves as, we're the right fit for people at a certain stage of their life. And, we think that demand should continue. So we have a really good, kind of long-term outlook, and we try to manage our communities and build our communities, really with that kind of longer-term outlook in mind.
Yeah, such a great point. I mean, a few things you hit on there I'll briefly comment on is I had Dallas Tanner from Invitation Homes on our podcast a few months ago, and he made the same point. It's like, look, like there's this perception that if you're an SFR, I guess BTR, that you benefit from a low homeownership environment. That's not really true. At the end of the day, it's like you said. I mean, you want a healthy balance, and if people are moving out to buy a home, like you're providing a transition point to that, and so it's and I think also too, even from a BTR and SFR perspective, if we have the mindset that we can only thrive when homeownership doesn't, then that's also wrong. Like it's not that cyclical. We've seen obviously BTR, SFR, apartment demand be really strong when homeownership demand is strong. So I think it's an important perspective you have there.
I think that's a great point. You've made that several times. Dallas made that as well. And I think when you go back, excluding COVID, you go back to like 2018, 2019, the housing market was generally healthy, right? Yep. We didn't have super low rates, but there was demand and there was movement. And that's what we thrive on, is when people are making the decision to sell a home and move, whether that's within a market or to a new market. And so I think that perception or that misperception that, yes, this is the time that SFR and BTR should really be in demand is just really not the case, because people are not moving like they once did.
Yeah. And by the way, I tell, GPs that are talking to, trying to raise capital, the same thing, which is, hey, look, if your strategy is all based on people can't buy houses, what are you going to do when the environment changes again? Like you have to change your story. And so you can say, hey, this is a contributing factor, sure, but this isn't a short-term story, to your point. Like I think you and I agree that, BTR is still in its early innings and it's going to be resilient to these movements and homeownership and whatnot. Let me ask you another question, Branden. So is one of the things I like about what y'all doing is that I know you're doing some things that are I would call more suburban infill. And historically, maybe for those who are listening and watching, BTR is more associated with I would call exurban kind of sprawl development. I'm based in the Dallas-Fort Worth area, and a lot of people around Texas, think of the Highway 380 corridor, Prosper, Salina, and then all the way out to places like Melissa. Like that's where we've seen a lot of this BTR development, and we could draw parallels other parts of the country as well. But as you're one of the questions I've asked BTR developers for years, it's like, hey, like what would get you to go more traditionally suburban infill? And I've never really gotten a great answer for that. Like what does it take to do it? And why is that play attractive? And so as you're going more suburban infill, I'd love to get your take on it.
Sure. Well, I think it's really a simple answer, which is we've decided to try to build where we already know people want to live, right?
Yeah.
Instead of you want to take the Dallas Fort Worth market, and going back to what I was saying early on about our initial thesis, when we started expanding across the country, frankly, the low hanging fruit was the master plan communities. We'd already proven up that concept in the Phoenix market. It was easy to look at a map and go, okay, where's the top 50 master plans across the country, or the top 25, and start working on acquiring land in those locations. So to your point, in Dallas, our first two communities in the DFW market, we're up at Light Farms, up right in there in Prosper and Salina, and we're at Harvest over in the Argyle, kind of the Fort Worth side, a Great Hillwood community. And those are fantastic communities, but they are a little bit further out, right? But they have good schools, good demographics. And obviously today it's not necessarily as affordable as it once was to buy a home in those locations. So we've seen pretty good demand. But as we've evolved over time, we've really wanted to move closer in, to your point, more of these like kind of urban, suburban locations. So we have a community in the Colony at the Tribute, which is another master plan. But as we've gotten into our second fund over the last couple of years of acquisitions, we've really moved further in. And it really is just driven by what I said. We're trying to build in locations that people have already proven up demand. So in the staying on the Dallas market, Frisco, Grapevine, really trying to get into that interior of the market. And really part of that is also our strategy of being at the higher end of the rental rate range. So that makes it a little bit easier to absorb the higher land prices and the costs of doing business in those locations. But that's really been a strategy that we feel has a lot of value. And yes, it's moved us out of the master plans and a lot more of our own standalone communities. But we're doing deals here in the Phoenix market. We have a community in North Scottsdale that's coming out of the ground in the next couple of years. Down in Palm Beach County, Florida, Naples, Florida, and again, that's really just all about the idea of let's go build where we know there's demand, and delivering a product that there's just not a ton of in those locations either.
So as you're doing that more suburban infill, does the product type change? I mean, obviously you need higher rents. You only mentioned that, but are you changing your floor plans and whatnot?
So it really depends. We've always been of the mindset that our default is to build a single family detached 3 or 4 bedroom home. Right. So that has always been kind of the core of our thesis, going back to my partners, the co-founders of BB Living in our first community. So we still stick with that. But obviously, when you get on a more infill location and a little bit of a tighter site, we also have built, quite a bit of townhome product. And so we'll build townhome product if it calls for it. And we're only going to do that if the market demand for it is there. Right. So, in Prosper Salina, probably not going to build a townhome. In Frisco, we can build a townhome, still feel like we can get the demand and the rents. And, we're always kind of iterating from a product standpoint, trying to deliver a better product to our residents. But the kind of core thesis and the core product, 3 and 4 bedroom, attached 2-car garage, that product is staying very consistent.
And let me ask you another follow-up question on that. So why is it that, I mean, y'all are going different spots, but I mean, the industry, it tends to kind of cluster together, and, you could probably, get a heat map of BTR product in the US and you'd see a few hot spots in suburban Phoenix, suburban Dallas, suburban Atlanta, on down the list. Like, do you think that's, as you look kind of just the broader market, not specific to just, your company, is that just the kind of the nature of, is it just easier to kind of follow the path of what's become a proven market, or is there some hesitancy of capital to be forged into new submarkets and markets? What's your perspective on that?
Yeah, I'd say it's really looking at it and saying, okay, kind of both the near term, where is the demand going to be? And so obviously path of growth locations in some of these submarkets, whether, it's north of Tampa, for example, right? As you get into the northern parts of Pasco County, Wesley Chapel, there might be 40 different build to rent communities up there now, right? There's a lot of activity up there. And I think that's because people saw demand of plentiful supply of land at relatively affordable prices. You could build a good home. And again, that's just the path of growth there. But I think to your point on the capital markets side, it is one of those things where the investors really want to be in locations where they know there's going to be that next buyer, right? You spend a lot of time talking about some of the emerging markets in the Midwest or some of these other secondary or tertiary markets, and we can all quibble about what the definition of a secondary or tertiary market is. But I think, that's a big part of it is, if you're doing this from more of a merchant build perspective, you need to have that visibility to know that there's going to be demand and robust demand from a buyer pool that's going to want to be in that location. And so I think that's why you're seeing these clusters in these metro areas, for example.
Yeah, that makes sense. So that kind of ties into the demographic. So, because obviously you're following demand, like you mentioned. So talk to us about kind of your renter profile. Who lives in a BB living community in terms of, the ages, kids, employment types, if you know that. I mean, what do you know about your renters that you can share?
Yeah, sure. So our renter base has really stayed pretty consistent over the years. I mean, average age is a 39-year-old adult. It's two adults, one child, half a pet, making $175,000 a year. And, one of the things that we have seen that's a positive is, with where affordability is today and where rental rates are, our rent to income ratios have stayed very consistent in that kind of high teens to 20% range, which we think is a positive from a market standpoint, that there's opportunity for rents to grow in the future and still to be affordable for most people. And I think, from an employment standpoint, again, where we're trying to build our communities, having proximity, whether it's to the Dallas North Tollway, letting people, get there quickly to their places of employment. We see a lot of, typical kind of white collar jobs, a lot of real estate, construction. It's a really broad base. We have first responders in our communities throughout the country as well. So I think, that's one of the things that we are seeing, contrary to my earlier point of not getting enough kind of the, the broad-based consumer support for the asset class yet. But we really do see a broad range of individuals and people living in our communities. And it does vary by market. So you go down to Southwest Florida, our Lakewood Ranch community, Antigua at Lakewood Ranch certainly has a slightly older demographic, and we've built product to support that as well. And so I think you're seeing, kind of both ends of the spectrum, young families, mature couples, downsizing, all finding a place in a BB living community and in build to rent at large.
So when you $175,000 income, obviously that's substantial. Sometimes when we share numbers like this, I've seen others of your peers have shared numbers like that, and you're like, well, that's just because people aren't $175,000 doesn't buy a house anymore, and so they're choosing to rent. But how much of that is really just the nature of people who are choosing to live in a BTR community at this stage of life, even prior to the rise in rates? I mean, I guess what I'm really asking you is, like, do you perceive that the kind of that narrative is true, or do you perceive that, hey, like BTR is catering to a relatively high income, affluent base that for whatever reason just isn't willing or able to buy a house, at least in the preferred neighborhood they want to be in at this point?
Well, I think that's what you said is exactly correct. It's really, can they afford the home that they want to buy, right? So if you're going to live in some of these communities and in a lot of the locations that we're in, the kind of the entry level home price is $700,000 now. It varies by market, but that's not all that affordable these days. And when you can still get the good schools, you can get a good quality of life. I think people are seeing, hey, at least for the near term, this is a better option than going and buying a home. And we can all talk about the math and the rent versus own math, but even just the idea of, like, if you're only going to be in a home for a few years, the friction costs, the potential for home price appreciation or not, does it really make sense to buy a home in the short term? And I think one of the things, because of the locations that we're in, we are still seeing people that are moving from out of state to some of these locations. So it does, again, give them that chance to do the try before you buy. And while that in-migration has slowed, or that net migration has slowed, there's still enough of that where there is demand from people, relocating from the Northeast down to Florida, from the Midwest to Arizona. And so I think that's one of the things where people are just saying, hey, I don't need to buy a house right now. Let me get into this location. Let me see if this is the area I like, and let's see what happens with home prices over the next year or two.
Yeah, no, that's a great point. I think ultimately, like, even like you said, prior to rates rising and everything else, and home prices getting high as they were in some of these master plan communities, the median home price in the areas you're talking about were always higher in the metro area. So people would say, oh, well, it's $400,000 homes to purchase in this. Well, that's to go live in a part of town they don't want to live in, right? They want to be in the places that you're actually talking about, which I think why is BTR plays such an important role. Really, SFR too, being able to live in a single family home if you can't afford to or don't want to buy one for some reason. Branden, let me ask you another question about just kind of big picture. It's been a roller coaster these last few years, obviously since COVID, last 5 years now. Golly, it's been that long. just as we went from this just kind of crazy demand period and high inflation rent growth to now a more higher supplied environment, more challenged rent environment, higher rates. Just I guess just broad question here. I mean, talk about how's the environment changed, or how is the changing in the kind of macro environment really impacted your business, your strategy, and what you're kind of seeing in the market?
Yeah, I mean, it's definitely been a roller coaster. It feels like since the day we started working on our expansion plans going back to 2019, we had very little of a period of time that was actually kind of smooth sailing, so to speak. It's been
Yeah.
one thing after another, to your point. COVID, the supply chain shocks, yes, rent increases, but cost increases that have, not really abated all that much. And then we get into the higher rate environment, which, in a rental housing industry that's based on cap rates, that's not all that great news. So it's really been a lot to handle. And I think that's one of the things that, frankly, going back to when we started, people thought, oh, build to rent was really just a thing coming out of the GFC because people needed to rent because they couldn't buy a home due to a foreclosure or bankruptcy or whatever it is. But build to rent has really shown resiliency over the last 10, 15 years now. And I think for us, it's really just continuing to kind of put our heads down and go to work. I think the biggest thing that the macro environment has impacted is the volume of deals that we can do, right? So we like to try to target kind of a new deal every month, right? And going back to 2019 to 2021, we're able to achieve that. We started our new fund in 2022. We only did 2 transactions in 22 and 2 in 23. And then, last year we got back to a, decent number of 6, and I'd like to do another, 6 to 8 this year. But I think that's the biggest impact is it's a lot harder to make things pencil today because costs are kind of stuck where they are. Rents have certainly softened, so you don't, get that kind of ability to kind of lean on the revenue side to make the deals pencil. And so it's really hard. I mean, we had to look at, hundreds, if not thousands of transactions every year to get to the handful that we will ultimately move forward on and acquire.
Yeah, no, that's true across the industry, of course, too. So, obviously, tariffs just add another variable. We had an episode a few weeks ago about the impact of tariffs in the apartment construction industry. We had Dan Hull and Scott Villani from NRP sharing. They think the impact is 1 to 3%, but on costs, but obviously there's still a lot of uncertainty around it, and that impacts the market as well from both the capital side and from the kind of renter demand side. So it's a very dynamic topic. I mean, just as we're recording this, we have some news that we could have a temporary agreement with China, which of course has been the main focus of tariffs. But where we sit today, how are you seeing tariffs and also just headlines about tariffs impacting your business?
Yeah, well, I'll take the last part first there. I think the headline impact is going back to what I was saying earlier. I think that is impacting demand. People are feeling less certain about the economy more broadly, their job security, whether it's a good time to move, whether that's just to rent a new home or they're going to move to a new location. And so I think that has really impacted everything, whether it's housing or consumer goods. It's seemingly impacting pretty much everything. I think from a true kind of construction perspective, we are not really seeing the impacts to date, right? You're certainly hearing of, hey, this might be coming from a cost increase perspective, but we're not quite sure yet. And really, I think, frankly, a lot of that will start bleeding into the next set of communities when we go out to bid, as we start the next wave of communities later this year, early next year. We may see some of that impact. But at the same time, with housing starts overall being a little bit slower as we've gotten into 2025, you'd like to think that maybe some of that is, kind of muted from an impact standpoint because there's a larger availability of trades and materials and labor for sure.
Well, it's a very thoughtful answer to that topic, Branden. You always have very good takes on what's happening in the market. So I appreciate your time today, and thanks for being part of the podcast.
Appreciate it. Thanks, Jay.
And that's a wrap for episode 35 of The Rent Roll. Big thanks for Branden for being our guest. Thank you to JPI and Waymaker for sponsoring. And thank you to all of you for making The Rent Roll part of your day. We'll see you next week.